Welcome to the deep dive.
Okay, so we've just waded through a pretty substantial pile of source material, all pointing towards, well, what could be the defining infrastructure story for the next decade or so?
Yeah, it's this collision, really, between the incredible power demands of AI and this kind of surprising comeback of nuclear energy.
Specifically, small modular reactors, SMRs. And look, our mission today is really clear, laser focused.
Yeah,
We're pulling out the actionable insights, the stuff you need as an investor. We want to cut through the noise and see where the money's actually going, what's really driving this.
absolutely. And the need for this, well, it really comes down to the data centers. The sources we looked at all agree. Electricity demand from AI, it's not just growing. It's set to grow 4 times faster than overall global demand.
4 times faster.
Yeah, we could be looking at almost quadrupling usage, maybe hitting around 945 terawatt hours by 2030. I mean, that kind of scale, it creates this immediate critical need for reliable baseload power.
That's the engine, right? That pressure is what's driving this whole SMR investment boom we're trying to track. Exactly.
That number is just staggering, 945 terawatt hours.
Mm.
It's like, what, the power consumption of a whole country, a big industrialized one?
Pretty much, yeah.
So, okay, big tech needs all this power. The big question for us then is, why SMRs? I mean, why aren't renewables like solar and wind the easy answer here? And how does this tech actually become something you can, invest in profitably?
Right. We have to tackle that why not renewables point first. And it's fundamentally about baseload power. Simple as that.
Meaning,
Meaning AI doesn't sleep, training models running inferences. It needs constant, steady power, 247, 365 days a year. Solar and wind, well, they're great, but they're intermittent, right? The sun doesn't always shine, the wind doesn't always blow.
so they can't guarantee that always on supply alone.
Not without enormous, really expensive battery storage systems. And even then, you're adding cost, adding complexity. SMRs, though, because they use nuclear fuel, they just run. They provide that steady, weatherproof baseload generation.
Okay, so they're nuclear. But how are they different from the giant nuclear plants we usually think of, the ones that kind of scared investors away for years?
And that difference, that's the whole investment thesis right there. SMR stands for small modular
Just
reactors.
small, modular.
Exactly. Those old, huge plants, they were bespoke projects, built slowly, piece by unique piece, right on site. In the industry, they call that FO first of a kind.
Which means delays, cost overruns,
Yeah,
just unpredictable.
totally. SMRs are the opposite. They're designed to be small, usually defined as putting out 300 megawatts electric or less. And crucially, they're made in factories as standardized modules.
Like Legos.
Kind of like heavy-duty industrial Legos, yeah.
Yeah.
Mass-produced in a factory, then shipped and assembled on site.
So the magic here is moving from that expensive one-off F-Oak experiment,
To N-Oak, nth of a kind.
of a kind. Standardization, that sounds like manufacturing efficiency, predictable costs, music to an investor's ears.
Precisely. That modular approach, it just inherently de-risks the massive capital investment needed. Plus, because they're smaller, you can actually put them closer to where the power is needed.
Like industrial parks or
Yeah.
right next to these giant data centers.
Exactly. And another key point the sources highlight is safety. Many new SMR designs are passive.
Passive safety, what does that mean in simple terms, like the teapot analogy?
Yeah, the core idea is still heat boiling water to make steam to turn a turbine like a teapot. But passive safety means they don't rely on complex pumps or active electronic systems to cool down if something goes wrong. They use basic physics, things like gravity, natural convection, to manage the heat.
So fewer moving parts, fewer things that can fail.
Right. It drastically simplifies the safety case, which could potentially make getting regulatory approval a bit smoother, or at least that's the hope.
Okay, so the tech seems sound, potentially safer, more predictable, but nuclear projects, they're famous for being incredibly expensive up front. How do you actually pay for these things? That
Right.
seems like the real hurdle.
And that brings us right to big tech's role here. It's all about the power purchase agreements, or PPAs.
Right, the PPAs. Explain how these documents suddenly make a risky long-term nuclear project investable.
Okay, so think about it from the developer's perspective. To build anything this big, especially nuclear, you need financing. Banks won't lend you billions without some guarantee you'll actually have customers paying you back over the long haul.
Makes sense.
What big tech companies are doing is signing these 20-year PTAs. They're basically saying, we promise to buy this much power at this price for the next 2 decades. And these are companies with, extremely strong credit ratings.
Like AAA credit rating.
Exactly. That long-term guaranteed cash flow from a super stable customer. It completely changes the math for the developer. It provides the certainty needed to secure the loans. It fundamentally de-risks the project from a financial standpoint.
So these PPAs are the bedrock. What are the key examples the sources brought up?
Well, the source is really focused on Constellation Energy. They run the biggest nuclear fleet in the U.S. First, Microsoft signed a huge 20-year PPA with them. It's for power from the 3 Mile Island Unit 1 plant, TMI-1. And this deal is actually supporting Constellation's plan to restart that plant by 2028, specifically for AI demand.
Wow. Restarting TMI, that's significant.
It really is. And then Meta, Facebook's parent company, also signed a 20-year deal with Constellation. This one's for power from their Clinton plant in Illinois, and it helps support keeping that plant running and even expanding it.
So it's the length 20 years and the quality of the customer. These tech giants are essentially acting as financial anchors for these projects.
That's the perfect way to put it. They're guaranteeing revenue for decades. And that guarantee is what unlocks the billions needed for construction and operation.
Given this massive catalyst, what kind of market growth are we actually talking about here? The numbers must be pretty big.
Oh, they're stunning. The forecasts suggest SMR investment could jump from around, say, $2.5 billion a year right now to potentially $25 billion a year by 2030.
Wow, a tenfold increase in just 6 years.
Yeah. And if that holds, the cumulative investment by 2050 could be something like $670 billion. And look, this isn't just a U.S. story either. We're seeing this globally.
Like the UK example.
Exactly. The UK government picked Rolls-Royce SMR as a national priority, backing it with a $2.5 billion Act Room program. Plus, you see the U.S. and UK governments specifically announcing cooperation on powering data centers. It's gaining international momentum.
Okay, this brings us squarely into the investment side of things. If this market's poised to grow 10x, where should you as an investor be looking?
Yep.
Let's maybe break it down. The sources seem to point to different kinds of plays, right? Like the pure tech developers versus maybe the established utilities.
That's a good way to think about it. And just a reminder, of course, this is just synthesizing the info from the sources, not investment advice.
Naturally.
So if you look at those pure play technology companies, the key word is volatility. Their success is almost entirely tied to hitting technical milestones and, crucially, getting regulatory approval.
Like NuScale, ticker SMR.
Right. NuScale saw a big stock rally when they announced that huge 6-gigawatt deployment program with the Tennessee Valley Authority, the TVA Entra 1 program. That's massive validation.
Right.
But you absolutely have to remember they also canceled a major project out in Utah just last year, back in 2023, because costs were getting too high. So their stock can swing wildly based on news getting a license, signing a deal, or facing a setback.
High risk, potentially high reward. What about Oklo? They focus on even smaller microreactors, right?
Yeah, Oklo, ticker OKO. They had this incredible run-up, something like 21x over 12 months at one point. But again, that's driven almost entirely by optimism around their unique tech and the hope they'll get licensed. It's very speculative at this stage.
Okay, so those are the high flyers maybe. What about the, let's call it the lower risk utility angle?
That's where a company like Constellation, ticker SEEG, comes back into the picture. They're the ones actually signing those huge long-term PPAs with Microsoft and Meta.
So they benefit directly from that guaranteed revenue stream we talked about.
Exactly. They're an established utility already operating nuclear plants. These 20-year deals provide immense stability to their cash flow. It's a different way to play the rising demand for baseload power, leveraging existing assets and locking in revenue from these giant tech companies. Arguably, it's a safer approach.
Makes sense. Beyond the companies building the reactors and the utilities operating them, the sources pointed to a potential bottleneck, right? A critical piece of the puzzle that could be its own investment angle. I think it was about the fuel.
Yes, absolutely. This might be one of the most crucial insights, actually. It's about HAU.
HAU, high assay, low enriched uranium.
Right. Many of these advanced SMR designs, especially the smaller, more efficient ones, they need fuel that's enriched to a higher level than traditional reactor fuel, somewhere between 5% and 20% uranium-235. That's HALU.
And why do they need it?
It allows them to get more power out of a smaller reactor core, and it can also mean they need refueling less often, makes the designs more compact and efficient. The problem is, historically, there hasn't been a large, reliable commercial supply chain for HLEU, especially outside of certain foreign sources.
Which creates a strategic vulnerability and therefore an opportunity.
Precisely. And the company highlighted in the sources to address this is Centrus Energy, ticker LEU.
LEU. Okay.
They're positioned as the first commercial producer of HALEU in the United States, and the key catalyst everyone's watching is their plan to deliver the first 900 kilograms of HALEU sometime in 2025.
So that delivery is a huge milestone. It kind of unlocks the fuel supply chain.
It's a critical first step because, frankly, without a reliable, scaled-up HALEU supply, it doesn't matter how many PPAs big tech signs, these advanced SMRs simply can't run. So investing in Centrus is essentially a bet on solving that strategic fuel bottleneck for the whole industry.
That definitely puts them in a very strategic spot. Okay, quickly, who else is on the radar among the reactor developers, the OEMs, that investors should probably keep an eye on?
Well, you've definitely got GE Hitachi.
Yep.
Their BWRX 300 design is considered a serious early mover. They've got a project moving forward in Canada, aiming for a license at Darlington in 2025. And they're also deep in the review process with the TVA here in the U.S.
Okay, GE Hitachi. Who else?
Rolls-Royce, obviously, with that strong UK government backing we mentioned, that almost guarantees them a domestic market to start. And then there's Westinghouse. They're pushing hard internationally, signing deals like one with a company called Data4 to potentially power data centers in Europe with their SMRs.
Lots of players moving. Before we wrap this section, let's crystallize the risks. What's the investor checklist for potential hazards here? What could derail this whole rosy growth picture?
Okay, number one, regulatory delays. Always a factor with nuclear. Even with these newer, safer designs, getting licenses, especially from the U.S. Nuclear Regulatory Commission, the NRC, can be really slow and unpredictable.
Right, cost is still king.
Absolutely. Number two, capital costs. That NOA, nth of a kind cost saving, it's still mostly on paper right now. If interest rates stay high, or if supply chain problems persist, these projects are still very sensitive to financing costs. They could get expensive quickly.
Makes sense. The fuel.
Number three, the HLEU bottleneck. We talked about Centrus, but solving this requires massive scale-up, way beyond that initial 900 kilograms. The whole supply chain needs to mature fast. That's a major dependency.
And finally,
policy. Under four, policy dependency. Government support, funding, regulations, prioritization. These can all change. Look at how the UK prioritized Rolls-Royce. A shift in government policy could significantly impact which projects move forward and which ones stall. Highly sensitive area.
Okay, that's a clear set of risks. So let's try to bring this all together for you, the listener.
Okay.
Key takeaways from this deep dive. SMRs look like the leading solution for the massive baseload power AI data centers need. They're modular, potentially faster to build than old plants.
And crucially, this isn't just theory. It's being validated by those huge 20-year power purchase agreements from cash-rich big tech companies. Those PPAs are the financial bedrock enabling potentially hundreds of billions in investment growth over the coming decades.
So the actionable insight here.
Well, based on the sources, the advice seems to be, don't just bet broadly on nuclear, get specific. Focus on the reactor developers, the OEMs, and the key suppliers, like Centrus for HLEU, who are demonstrably linked to confirmed, publicly announced projects.
Like the OPG project in Canada, the TVA deployments in the US, the UK government-backed initiatives.
Exactly. Watch those specific projects. Keep tracking who's signing new big tech PPAs because that signals real revenue. And monitor that HLEU supply chain development very, very closely. That's probably the biggest near-term hurdle.
Excellent summary. Really appreciate you helping us synthesize all that complex material from the sources. It's a fascinating intersection of, well, cutting-edge tech demand and our energy future.
My pleasure. And maybe here's one last provocative thought for you to chew on, building off that risk list we made.
Okay, let's hear it.
The whole bull case for SMRs right now hinges heavily on those forecasts, like from the IEA, predicting absolutely massive growth in AI's energy appetite. But what if we see faster than expected breakthroughs in AI efficiency? Meaning more efficient algorithms, maybe much more power efficient chips for training and inference. What if the energy needed per computation starts dropping dramatically? If those efficiency gains actually start to outpace the growth in AI workloads,
then the overall power demand might not grow quite as explosively as predicted.
Exactly. So the question is, how quickly could that shift the SMR investment timeline? And if that happens, which companies are better positioned? Is it the established utilities like Constellation who are already making money? or the more nimble, pure-play tech companies betting everything on rapid deployment. Something to think about.
Definitely something to keep watching. A great point to end on. Go explore these ideas further. Thanks for joining us on the deep dive, and we'll talk to you next time.